All right. I think Ganesh and Gaurav, it was very insightful presentation. I mean, I learned a lot through the presentation, and I hope the viewers also had a lot of takeaways from the presentation. We would be opening up for the Q&A session now for the next 30 minutes. We have already received a lot of questions from the registration form itself. We have narrowed down the questions to address all of those, and if time permits, we will be taking up the questions which were dropped on the chat box right now. I would like to introduce the panelists for today who are along with us, Namrata, Athreya, and Priyadarshini. All of them are qualified chartered accountants. Namrata and Priya are from the financial planning team of ithought, and Athreya is from the research team of ithought. Welcome, Namrata, Athreya, and Priya. And all
Hi,
five
Srimati.
of you ready for the Q&A session?
Yes.
Yeah.
Yes. So I have a list of questions in front of me that I've collected from the registration forms. I would like to probably go one by one and I'll point it out to you. Maybe one of you, whoever is interested, can take up the question. So we had a very repeated question on, EPF and what are the rules of EPF, what are the withdrawal rules, etc. So Namrata, I would like to start with you. What are the withdrawal from EPF corpus and rules relating to it? Could you throw some light on that?
Sure, Srimati. Thank you for the question. So, with respect to EPF, I think this is one of the most asked questions which I also receive from my clients. And this is something which all of us contribute to, right? Um, as everybody knows, we have the limit to contribute at least 12% from our employee contributions towards EPF, and we also have the need if we want to do voluntary contributions to this fund. So coming to the withdrawal part, so complete withdrawal of this corpus is only possible in case of retirement. And also one can use this complete withdrawal only if somebody is unemployed. So as per the new rules of EPFO, around 75% of your corpus can be withdrawn if you are unemployed for say 1 month, and you can withdraw the remaining 25% if that unemployment stretches for more than 2 months. Earlier, the rules said that you can withdraw complete 100% if you are not working or unemployed for a period of 2 months or more. So the rules have changed now. You can still withdraw 75% if it's only 1 month of your unemployment. Uh, Talking about early retirement, so in case of EPFO, early retirement is not considered until you turn 55 years. But still, there are rules which says and allows you to withdraw 90% if you have at least crossed 54 years. So that also can be made note of. Sometimes we need money for certain emergency cases. So EPFO also gives us the liberty to do partial withdrawals, and the reason can be a medical reason or buying a house or construction, as well as you can do it for higher education needs. So that is on partial withdrawals. Coming to the taxability part. So as Gaurav had mentioned in the PPT, that taxability for EPF withdrawals are done if it is not crossed 5 years of consecutive years of contributions, right? So if you have not done 5 years of continuous service towards this, then I would not request you to do the same because it will be taxed at your slab rate, and also TDS is deducted at 10% on these. So coming also, if you are planning to withdraw not more than 50,000, then it is completely tax free. So that is also something which one should know. Um, yeah, I think as the process has streamlined with EPFO, you can completely withdraw it directly on the site without going offline and getting approvals. So that is something can be done if your UAN and Aadhaar are linked to it. So that is on withdrawals of EPF.
So the withdrawal is from the EPFO website, you mean? We can do it online itself.
Yeah, you can file claims on transfer as well as you can do it directly on EPFO, provided it is linked to your Aadhaar.
Okay. So one more question on the EPF itself. When does account become inoperative, and how about interest on non-contributing EPF accounts?
So that's a very interesting question. Like most of us also have those doubts. So generally, if one is leaving a job or a person who's retired and there are no fresh contributions which are going to the EPF account, in that case, you still get to earn the interest, right? The EPF have the rules which says that the interest will be given to them for at least 3 years' time. But the important point here is this interest which you earn on the non-contributing part will be taxed, and it will be taxed at a slab rate. So this is something which not most of us know. Also, talking about the inoperative account, so a account becomes inoperative if no contributions have gone for at least 3 years, continuous for a continuous period of 3 years. Also, if somebody has moved abroad or have retired, in all these cases, there are no contributions which go. So these are the reasons when it turns inoperative.
So, I mean, just continuing on the EPF part, because we had like a lot of questions.
Sure.
Employer also contributes for EPS and EDLI. Can you share some points relating to the same?
Sure. So normally employer contributes 12% for our retirement benefits, and from this 12%, as mentioned, around 3.67 goes towards EPF, and from that 12%, 8.33% goes towards your pension, and remaining goes towards EDLI and admin charges. So talking about the EPS part, so if a person has remained he's working and is connected with the EPFO side, like the contributions are being made from his side, then in that case, he need to be completing 10 years of service to get the benefits of pension. And also he may get, the pension will start once he reaches the age of 58. So that is on EPS. One should also know that there is no interest which will earn on this. It's only the pension which will receive on crossing that age. Also, for the EPS, there is a calculation which is done, which is based on the average monthly salary, and that is multiplied with the number of years of service divided by 70. So that is how the pension is calculated. As you were talking about EDLI, so EDLI is nothing but the insurance cover which is provided by the EPFO side, and this is for the employees, salaried employees. So if a person's nominee receives a lump sum amount in the event of death of the employee during the period of service, and recently government have increased the benefit which is now available for up to 7 lakhs.
This is something interesting. I think many people may not know about it. Thank you, Namrata. Thank you for answering those questions. I would like to take up another interesting or most repeated questions. We have presented that in the webinar also, but we keep getting these questions again and again. Priya, if you would like to answer this question, any other deductions which are available other than ATC? I mean, this question had come in like a lot of different forms. Best investment options, what do we do for deductions? Can you throw some light on those deductions, Priya?
Sure, Srimati. Thank you. Thank you for the question. So yes, so I think most of us know about ATC, where you can claim a deduction of up to 1.5 lakhs. There's also ATCCD, I think we've briefly covered in the presentation also. So there is this additional deduction of up to 150,000 that you can claim by investing in EPS. And you also have ATD, so where you pay health insurance for yourself and your family, like you get claim up to 25,000. And if you're paying it for your parents as well, I think you can claim up to 25,000 in addition. If your parents are senior citizens, then you get an exemption of up to 50,000. So totally, for yourself and your parents, you get a total deduction of up to 75,000 under ATD. And there's also ATE, where there is interest on education loan. You can claim for up to 8 years. So there's no limit on how much you can claim, but the period there's a constraint on the number of years. So you can claim for the interest for up to 8 years. And there's also this new section 80EEB that Ganesh has covered, that, for the loan that you've taken on purchasing electric vehicles, you can claim an deduction of interest up to 1.5 lakhs. So, and there's also 80TTA. This covers interest income that you generate from your savings bank account. This can be claimed up to 10,000. And there's also 80G. that you have deductions on donations. So any income that you donate to charitable organizations, this is going to be exempt from tax. And but one point to note here is cash donations cannot be claimed, and it is exempt to an extent of up to 2,000. So anything over that cannot be claimed as a deduction under 80G. And there's one more interesting section, 80GG, where you have, if your company does not have HRA as part of your pay structure, then you have this option under 80GG where you are also allowed house rent allowance. So this is basically how it works. Like, there are three parameters. You should evaluate the least component out of these three, and you would be eligible to claim deduction. So one is like 5,000 per month, and second component would be like 25% of your total annual income, and the third component would be your total annual rent minus 10% of your basic annual income. The least of the three, you will be eligible to claim under a deduction under 80GG. So these are various other sections that you can make use of in addition to 80C to make the most of your deductions.
All right. Thanks a lot. I think that would have given a bit of takeaways for the viewers. Namrata, coming back to you on the EPF and the retirement benefits itself, we had a couple of questions today on the chat box also. What is the taxability like for the retirement benefits that we receive? EPF, EPS, gratuity, are these taxable? How is it structured?
Thank you for this question. So as mentioned earlier, with respect to PF, you can completely withdraw retirement, and that time it won't be taxed since it's an exempt category. With respect to gratuity, so let me talk about how it works for government and non-government employee. So for a government employee, both your gratuity and PF receipts are exempt from tax. However, in case of non-government employee, a gratuity is exempt only subject to certain limits as per the income tax rules. So as per the rules, lower of, so last salary drawn, which is your basic plus DA, into number of years of service into 15 by 26 or 20 lakhs, or the gratuity actually received. So the least of the three is actually exempt from tax. And whatever excess you receive on your gratuity, apart from this lower limit, will be taxed at your slab rate. So this is how gratuity is taxed. I think I've answered your question, right?
Yes, it does answer. Ganesh, I would like to ask you a question which has been repeatedly being asked on the chat box. Which regime should I opt, old regime or new regime? So what would be your take on that, Ganesh?
Thank you, Srimati. So, as Gaurav had already mentioned on the presentation, it depends on a case-to-case basis, right? Depends on whether the employee is going to avail all his deductions. In such a case, if he has the option, or if he has the option to get all the deductions that are available from 80C to 80U, which are applicable only for the old regime employees. In that case, he should go ahead with the old regime. But again, this is from a case-to-case basis, and it has to be independently approached because it is only a mathematical exercise that one has to follow, as Gaurav had mentioned. So anyone who is looking at it just simply, with if someone comes and asks you a question, I have a CTC of 15 or 20 lakhs, which one should I choose? The answer is not a straightforward answer because it carries a lot more, it carries something more than that for you to evaluate each case and then give an answer. So it is not a very simplistic answer, or it is not a straightforward answer. So it changes from case to case basis. And if someone who needs help with that can definitely approach their advisor and then check out which one would be more beneficial for them in a tax saving perspective.
All right. Thank you. Thank you, Ganesh. And there were a couple of questions on REITs and InvITs taxation on the registration form. Atreya, would you like to take up that question and throw us some light on how REITs and InvITs are being taxed?
Yeah, thank you for the question, Srimati. So REITs and InvITs are an exciting, and evolving space which is not well understood. So every investor should seriously take a look at REITs or InvITs as part of their asset allocation strategy for both fixed income as well as capital appreciation. So let me just share how these InvITs are structured. So generally, there is a REIT or InvIT, and they have something known as a special purpose vehicle, which is basically a subsidiary, and which through which their investments are routed through. So these REITs and InvITs are listed on, most of them are listed on stock exchanges. So you can buy and you can trade these REITs as and when you like. So moving on to the taxation, let me try to quickly summarize it, as there's a lot of nuance in this subject. So first, you can either make income via two ways. One is capital gains, and one is via the distribution made from these REITs or InvITs. So capital gains is treated similar to equity shares, but the only difference is that the holding period has to be 36 months for it to be treated as long term. Otherwise, all the rates are similar to equity shares. So let us move on to the taxability of the income which is distributed from the REITs. So there is some nuance to this. So the income which is distributed from the REITs, the taxation depends on the underlying character of the payout. That is how the REIT or the InvIT earns that income in the first place. So they can earn the income mainly in three ways, and the taxability depends on it. So the first way, where a distribution is taxed, in the manner of the distribution is in the manner of a interest payment. So interest payment is taxed in the hands of the investor or the unit holder at their applicable income tax slab rate. Similarly, for a REIT, the rental income passed on to the unit holder is also taxed at the applicable slab rate. So moving on to dividends, which is the other possible way of distribution. So in dividends, there are two ways of taxation. So one, if the REIT or the InvIT opts for the newly introduced lower corporate tax rate, since they are the REIT or the InvIT is taxed at a lower rate, the unit holder is liable to pay tax on the dividends which they have received. However, the REIT or the InvIT pays tax at the old rate, which is higher, then the unit holder is exempt. So when a REIT or InvIT makes these distributions, they will disclose all these details. So it won't be too much of a hassle for you to figure this out. So there are also other ways whereby the REITs or InvITs distribute income, because they can give loans to their SP special purpose vehicles, which are their subsidiaries, and the subsidiaries will repay these loans and they will distribute these back to the unit holders. However, all these other kinds of income are exempt in the hands of the investors and are taxed at the hands of the trust, that is the REIT or the InvIT. So I think this broadly answers the taxation aspect of REITs and InvITs.
Yeah, thank you, Atreya. I think this is a very interesting space, REITs and InvITs, which is being explored, right? So thanks for throwing light on that. Coming back to Namrata, actually, like this standard deduction that we spoke about in the presentation also, right? Whether it is applicable for employee of central or state government.
So with respect to standard deduction, so from financial year 1920, this limit was increased from 40,000 to 50,000. And this is allowed to be deducted from your income from the head salaries. And again, as the question you asked, whether it's applicable to either of central or state, it is applicable to all class of employers irrespective of the nature of employer. So it doesn't depend on that. One important thing to note here is in the definition of salary, you also have pensions which you receive from your current or former employer as part of it. So if somebody is receiving any such pension, that also can be used after deducting the standard deduction. Also, but family pension or the pension which you receive from the LIC, that will not form part of this, as that is taxed under the head income from other sources. So this is something which you should note.
All right, thank you, Namrata. Coming back to you, Ganesh, for another question. We had a interesting question, like parents have been distributing some shares from their account to their children. What are the tax consequences of these transactions?
Okay, so thank you, Srimati, actually, for giving me the easiest question to answer among the lot. But then, though the answer to this is pretty easy, it is very prominent in our country, distribution of shares from the parents' account to the children's account. So from an Indian income tax perspective, any sum of or any property of or any sum of money or property which is including your shares to your son or daughter would not trigger a taxable event. This would not be taxable either in your hands or your child's hands. Basically, when the child subsequently sends these shares received as a gift, he can claim your date of acquisition and your cost of acquisition as his own date and cost of acquisition respectively. To repeat this, when you transfer shares to your children, what happens is that does not trigger a taxable event. When the child tries to sell these shares, which he or she had received as a gift, that child can claim your date of acquisition and cost of acquisition as their own date and cost of acquisition respectively. In this case, it is important to evaluate the stamp duty implications also. This is apart from the taxation part. So in case of taxation, it is taxable only on the ultimate sale of shares by your child in the same way that would have been taxed in your hands. I hope that answered the question, Srimati.
Yes, it did. I mean, I will remember this if my dad ever plans to transfer his shares to me. I think that's helpful. We had Mr. Chidambaram from the guest who has raised his hand. Sir, I would like to invite you to type out your question on the chat box so that we can take it up if we have the time. Moving on to the next question, Priya. So there was a question on how far the employer can help the employees to save taxes. Is there something we can, talk out with the employers to help us structure our salary and taxes better?
Yes, Srimati, thanks for the question. So employers can help employees by offering a very tax-friendly salary structure with allowances, perquisites, which are exempt and based on the needs and requirements of the employees. So basically, there are multiple ways in which employers can help employees. So one way is by EPF contribution, which is mandatory, and the employer can contribute towards the employee provident fund, and NPS contribution, where you get exemption of up to 10% of your basic salary under ATC CD1, and there are other ways through which, like the employer can take care of the medical insurance of the employee and his family, and he can reimburse the phone bills, and they can also provide food coupons or meal vouchers to the employees, which would be like a perquisite and which can be exempt. And there are LTAs, leave travel allowances, that can be a component in your salary structure. And the book materials, there are some more allowances that is also briefly covered in the presentation. So just summarizing it all, book materials that are given to employees, there is an exemption limit through which it can be exempt, and the fuel allowances, HRAs. So all these options can be explored by the employees. Probably after attending the session now, the employees now, our viewers can go back to their employers and renegotiate and restructure the salary slip so that they can make use of the allowances and exemptions to the maximum extent. I hope this answers your questions.
All right, thank you. Ganesh, there has been a question from Mr. Chidambaram. Can the interest on personal loan be claimed tax deduction if the loan is used for house renovation purpose? I read in the internet as so. Can you please explain it?
Just to add one point here, see whether you take a home loan or whether you take a personal loan, maybe from your friends or relatives, right? As far as it is for the purpose of repairs or renovation, etc. If you are able to prove the actual usage of that personal loan was gone towards the purpose of renovating your property, then you can show that proof and avail the deduction. So we need to keep this point in mind that if you are spending the amount borrowed towards renovation or repairs, and if you have the proofs of those things, right, then it doesn't matter, according to me, to whether it's a personal loan or whether it's a home loan. You can go ahead and avail the deduction under Section 24B, I think. So maybe we can reach out to Mr. Chidambaram separately and explain it to him in details what his exact query is.
Sure. Thank you, Gaurav. So there have been questions on NRI taxation, and I think Ram Kumar has also asked for NRI taxes on investing in equity mutual fund. Namrata, would you like to throw some light on NRI's domestic taxation?
Sure. Thank you for this question. So before getting into what are the taxation impact for NRI, let me just throw some light on what is a residency rule. So according to the Income Tax Act, a citizen will be resident if he or she is in India for at least 182 days in that year, or if he or she is in India for at least 365 days during the last 4 previous years, and at least 60 days during that year. So for an NRI, there's an exception if they're having a total taxable income in India which exceeds 15 lakhs. In that case, if they were in India for at least 120 days in this current year and were in India for at least 312 in the last 4 previous years, then they will be categorized as residents. So if they satisfy this condition, then I think the taxability will be a question. So if there's something which they're earning in India, say if they have invested into various investments like capital gain, shares, mutual funds, or they are receiving rental property, then definitely taxation will come into place. Also, if they are somebody who's providing any services which are rendered in India, then the income will be taxed for them like any other resident, and that will be as per the tax slab rate for their salary income. If there's any rental income which they're earning from the property located in India for an NRI owner, then the determination will be as per the income from the head house property, which is like for any other resident. For say that you can claim the standard deduction 30%, you can claim principal repayment under Section 80C as well, and any stamp duty or registration charges as well, if you are having any rental income. For NRIs, there is a DTA relief which we have as per the Act. So if somebody is being taxed in like 2 countries, that is in India as well as in the country of residence, then they can claim this DTA relief. So as per this relief, there are 2 ways of doing it. One is the exemption method and one is the tax credit method. So under the exemption method, NRI will be taxed only in one country and exempted in the other. So you need to check with your star accountant specifically to see if both the countries or which country have the DTA provisions applicable. Also, under the tax credit method, the income tax allows you to get the tax relief, which can be claimed in the land of residence, like in the current resident place. So this is the taxation with respect to NRIs when it comes to domestic transactions.
All right. Thank you, Namrata. I hope that was beneficial for all the NRIs viewers. We have another question on NPS. Priya, if you could take it, could you give us a bit more light on NPS? And Sridhar has actually asked, can you give brief on NPS taxation, as it says 60% non-taxable, 40% taxable on annuity? How does this NPS work, Priya?
Sure, Srimati. So NPS has been a very popular retirement savings scheme, and this is regulated by the PFRDA. So this is basically structured in 2 tiers. So tier 1 account is meant for general retirement savings, where the government and private sector employees, they contribute. Tier 2 account is meant for general investment. So let's not talk about tier 2, let's focus on the tier 1 account. So basically you can contribute as low as 500 per annum to keep it active. And when it comes to the tax benefits that you get by investing in NPS, it's basically covered in 3 different sections. So 80CCD1 and 80CCD2 covers your self-contribution. So basically your salaried employees and self-employees. So salaried employees, they get a maximum deduction of up to 10% of their contribution of their salary, while self-employed individuals can get an exemption of up to 20%. And 80CCD2, that basically covers your employer's contribution towards your NPS. So, but this benefit cannot be claimed by self-employed individuals. So maximum that an individual can claim for deduction is going to be your employer's NPS contribution or 10% of your basic salary, whichever is lesser. So it's going to be 80 CCD 1 and 2 basically will be clubbed along with your 80C exemption. So the maximum deduction that you get under this is going to be under the bracket of 1.5 lakhs. But when it comes to 80 CCD 1B, that is going to be an additional deduction that everybody talks about. If you contribute an additional 50,000 per annum, you get a deduction of up to 50,000 as per this. So basically now you get like two investment choices when you invest in NPS. So there are asset classes A, which means alternative investment funds, which includes REITs, and the asset class G is investment in government securities, and asset class C is investment in fixed securities except for government securities, and asset class E represents investment in equities instruments. So basically you get two choices, auto choice or active choice. By default, you will be put in the auto choice, where you can invest in aggressive fund or a moderate fund or a conservative fund. And there is also active choice through which the subscriber can get the allocation. They can choose like how much he has to contribute between corporate fund or government fund or equity. So they have this choice, but the most important thing to note here is NPS subscribers, they can change their investment choice and asset allocation ratio up to twice a year. They can do it only twice in a year. But when it comes to taxation, this NPS corpus, whatever you accumulate, this can be withdrawn when you're 60 years of age. So when you withdraw, 60% of that is going to be not taxable. So whatever corpus you're going to take out, it's going to be exempt, and 40% can be converted into an annuity. So that's how this works. So I hope this answers your question, Srimati.
Yeah, so that annuity part is taxable, right?
Yes, yes.
I think that answers Sridhar's question. Gaurav, there was another repeated question on the chat box. I would like to ask that to you. Can capital gain taxes from real estate sale be avoided completely if I were to reinvest on a physical asset?
See, under section 54 and 54F, there are a lot of options available to reinvest the proceeds or the gains into other physical assets to reduce your tax liability. But to completely not pay any capital gains tax depends again on a case-to-case basis. We need to understand how much capital gains have been there and in what property or other physical asset one is going to invest. But yes, under section 54, there are a lot of options available for individuals and HUFs to reduce that capital gains tax liability.
Right, right. And also, could you throw us some light on HRA? I mean, I think we covered this in the presentation as well.
Yeah.
There have been repeated questions on, can I claim HRA exemptions? Can I rent to our parents' owned house to claim HRA? I think there's a lot of confusion around HRA. Yeah.
So I can see those questions. See, I'll tell you, one question is, can we pay rent to our parents' owned house to claim HRA tax exemptions? See, Income Tax Act says that if you are occupying the house by yourself, then only you can claim the HRA exemption. Otherwise, you cannot claim, right? Whether it is owned by your parents or by someone else, that is not the criteria. The thing is, you should be staying in that place and you should be paying rent to the owner. There should be an agreement and the money has to be gone from your bank account to the landlord. If these conditions are satisfied, I think you can claim HRA. There should not be any issue in claiming HRA. So I think this answers both the questions that we had on HRA.
Yeah. Since you spoke about section 24 also, there was a question. I'm paying home loan of 1.5 lakhs principal, 0.5 lakhs interest, or I think he means 50,000. How can I exemption of the extra 0.5 lakhs? I think he's talking about the interest part of the home loan to claim.
Yeah, this comes under section 24, where he can claim the interest paid on home loans up to 2 lakhs in a financial year. If the interest is more than 2 lakhs, he can carry it forward, but deduction is only limited up to 2 lakhs, not beyond that, under section 24.
Right. Okay. Thank you, Gaurav. Thank you. That answers a lot of questions. We'll take probably questions for 5 more minutes. There was another question, Namrata, if you would like to answer it. How to compute income from a property which is self-occupied for part of the year and let out for other part of the year?
Thank you for this. So at times there might be situations where we occupy the house for some time and we rent it out. So it's very common. And as per the Act, the treatment is to treat it as let out property itself for the entire year. So the computation will be like similar for what you do for let out property. So let me just state that as well. So when you compute the income from house property, the first step is to arrive at the gross annual value. So in this case, your property value would be the rental income which you're earning for the property for that part of the year. And then you can reduce your property taxes, which is allowed as deduction, which will give you the net annual value. And from that, you can reduce the 30% standard deduction, which is allowed as per the Act. One point to note here is you cannot claim anything as painting or repair expenses because we are getting this 30% reduction straight away. And post this, you can make use of the home loan interest, which Gaurav was stating in the previous question. So you can reduce that home loan interest up to 2 lakhs, which is available under Section 24. And the resulting value will be your income from the house property. And that will be taxed as per your tax slab rate.
Right. All right. Thank you, Namrata. And there was an interesting question on HUF. And there were some chats on the HUF also during the presentation. Atreya, if you could, take this question where one of our viewers had asked, can the shares held in HUF be distributed to its karta or other members? What would be the tax incidence? The HUF will continue as it is?
Yeah. So basically, HUF is a Hindu undivided family, and there are two types of there are two methods whereby a transfer takes place from the HUF to its members. The first method is a total partition where all the assets of the HUF are distributed to its members, and after the distribution, the HUF ceases to exist. And the other method is basically a partial partition, as the name suggests. Only certain assets are transferred. So coming to the taxability aspect of this, for both these partitions, the transfer from the HUF to the members is not a taxable event. So that is not considered as a transfer. So for a total partition, so once the assets are transferred to the members, then after the members sell it or any subsequent transactions, only then is there a taxable event. So obviously after that, other capital gains rules will apply. Then on coming to a partial partition, so a partial partition is not recognized by the Income Tax Act. So even though the assets have been transferred by the HUF to its members, the tax incidence for the asset which has been transferred will continue to be in the hands of the HUF despite the asset being transferred. So this is only for a partial partition, so this covers the HUF aspect of the taxation.
All right. Yeah. Thank you, Atreya. One of you can take up this question. We have shown it in the presentation also, but we have been getting repeated questions. What are all the default, exemptions available for salaried individuals? If one of you can maybe reiterate on the exemptions available, that would be great. We have been getting repeated questions.
Sure. So I'll just again brief what are standard deductions available for a salaried individual. See, basically any payslip will have HRA as a default item after basic and DA. So if you submit the proofs as we explained, that can be claimed. Secondly, standard deduction under Section 16. Namrata was saying it was in 2019, it was increased from 40,000 to 50,000. So that is applicable to everyone. 50,000 rupees straight they can deduct from their salary to compute the capital gains tax. Apart from this, a lot of companies also provide or do EPF contribution, both employer and employer. Even if they do not invest or invest in ELSs or PPF under Section 80C or claim life insurance premiums, still they will be contributing something to EPF. They should at least make sure that that amount is made part of the ATC and they claim it and they reduce their taxable income. But apart from that, all other deductions or exemptions depends on a case-to-case basis, which employer is providing, what type of allowances and deductions, and similarly what investments and expenses an individual is doing to claim those deductions. Like a lot of people have medical insurance premium, they can claim under ATD, ATTTA as Priya was mentioning, that is also there. Apart from that, if someone has a home loan, they can claim the principal under ATC and interest on home loan under section 24. So again, apart from 50,000 under section 16, many things depends on a case-to-case basis and very difficult to put any list out the deductions and exemptions.
Right. Thank you, Gaurav. One last question I would like to take before we, end the session, and if you could answer that: dividend from stocks are taxed under tax slab, or is it? Is there any other exemptions? I know before up to 10 lakhs per financial year is not taxed. Please explain. One of you, Atreya or Gaurav.
Yeah. So I'll take that. So right now dividends are taxed at the hands of the individual at their individual tax slab rate, and on paying dividends, if a company pays more than 5,000 rupees of dividends in a particular year, they will also deduct TDS. So what Mr. Satish had mentioned is basically there is no 10 lakhs exemption as of now. So all that has been removed. So basically it is taxed at your slab rate.
All right, straight and simple as that. Okay.
Srimati, there was one more very interesting question on what is relief under section 89. I'm sure many people here will not know about that, but it's an interesting section. I'll just take 1 minute to throw some light on that. I think Vidyashri has asked that question. So what happens in a year, an employee receives the salary, okay? So let's say 12 months salary has been received, but for some reason the computation was wrong, and in the next year there have been arrears in the salary for the previous year, and that is being paid this year. Now what can happen? Last year the income tax slab was, let's say, 20% for that individual, and this year it has become 30%. So unfortunately they'll be paying higher tax for that arrear salary, right? So this relief under section 89 helps us to make sure that extra tax is not paid for the arrear salary. And there's a whole step, I think 6-7 steps are there to compute at the final taxable income under relief under section 89. So we can reach out to Ms. Vidyashri and explain about the relief and the steps involved in detail.
Thank you, Gaurav. I mean, is it applicable for pension arrears also? Like if we receive pension arrears, is
yes,
that also?
any income that you receive in arrear, you can have that.
Okay. I think thank you. Thanks for sharing that. We will, end the session. We have answered for more than, I think, 30-40 minutes now. So if there are any more questions, you can reach out to us on the email ID or our social media handles or the phone number mentioned on the presentation. We would be happy to answer your questions and help you out with the tax planning aspect. Thank you so much, Gaurav, Ganesh, and all the panelists for joining us today. I hope our viewers had a very good takeaway from the session.
Thank you, Srimati.
So
Thank you,
I
Srimati.
would like to add, so anyone
Thank you, everybody,
whose questions have not been answered, anyone's questions in the chat box which have not been answered, they can also get in touch with the respective POC or advisor who's referred you to this webinar, and they would help you out actually with respect to anything that you would need relating to this. So
Right.
we would like to end the session with that note.
Thank you.
Thank you everyone. Thank you.
Thank you.
Thank you, everyone.
Thank you, everyone.